What you've been seeing recently in the Japanese yen, that's not a glitch. That's stress of the system. It's forced positioning. It's the global funding system absolutely choking up. This isn't Japan losing control. This is the dollar system itself cracking. And Japan is just where it all showed up first. Simply that. This isn't just about Japan. It's actually about dollar stress. Currencies, especially G7 ones, don't move in 1% intervals in minutes. Not in calm markets, not in normal markets, not in those markets where there's nothing to see here in the markets, not even in the deepest foreign exchange markets on earth. Let's stop dancing around it. Let's stop listening to the talking heads on the mainstream media networks. Let's talk about it what it is. It's the Japanese yen carry trade. Now, for more than 20 years, Japan has ran a near zero or zero negative real interest rate regime. 2 decades of free money, essentially, free funding. While the US and other counterparts all around the world have ran 4 or 5 or even 6%, now over 5.25% in some places, Japan always sat at zero. I mean, Brazil's at 15 right now. So the trade has always been obvious. Borrow yen at 0%, convert it into dollars, buy higher yielding assets, often abroad or at home, and you pocket the spread. In huge size as well, right? But that's not actually clever. That's structural arbitrage. It's something that big banks have been doing since time immemorial. And when everyone does the exact same thing for 20 years, that's when it becomes problematic, because it becomes foundational to all global markets. Everyone depends on it. Every asset is derived from it in some way or some shape or form because it's funded by it in one leg or another. So everything becomes super entangled and super fragile. There is a scalability issue with this, a truly daunting scale that no one will ever really talk about or tell you about, because here's where the lies start. You're going to hear people say, yeah, the carry trade, the yen-Japanese carry trade, it matters, but it's just niche, it's isolated, it's idiosyncratic. But that's false. Conservative estimates put the yen-funded carry trade exposure towards $5 to $8 trillion. Now, when you include other assets like FX swaps, derivatives, cross-currency basis trades, derivative products that are exotic and niche, structured products, you're looking at more like $20 to $30 trillion of exposure. Now, let that sink in. The United States GDP is in the 30 trillions. China is in 25 trillion ballpark area, roughly that, right? What's a few trillion here or there in my maths and estimation? But if you're looking at that type of exposure and it can unwind instantaneously or even over a few days, that can lead to a cataclysmic event. That is a larger amount than the US GDP. This isn't a hedge fund trade. This is how risk is funded globally on a systemic basis. But how did the leverage even get this big? How did the leverage get so big? Obviously, it's just the greed. No, it's not always just the greed, although that is a very alluring idea, right? And oftentimes it's right. Well, it's because volatility has been incredibly suppressed, incredibly crushed, and it's been done with adroitness. From 2012 until 2022, dollar yen volatility averaged only under 7%. That's absurdly low for FX volatility. That means the currency is only moving up or down 7% in a year. That is very, very suppressed, very, very predictable. And that's why these regimes can prosper. In fact, we actually need those regimes because low volatility means banks can increase that leverage. They can increase those bets. They can fund those bigger position sizes. And the risk managers can relax a little bit more. They can loosen their limits and they can lend with more alacrity and freedom. Because if it never really moves more than 7%, there's nothing to worry about, right? I mean, until there is something to worry about. Because Japan did something that it's not actually supposed to do in this like globally unwritten rule system where Japan funds the rest of the world's largesse. After 30 years of deflation, Japan finally got inflation. They had deflation for 30 years, but they've actually now managed to conjure up some inflation. Core CPI above 2% for the very first time in decades. I know that sounds really normalized to us in the West, but in Japan, it is literally unheard of. They've been trying to get inflation up for years and they finally have. But worse, inflation expectations are rising, because sometimes the expectations of inflation rising is worse than the actual inflation itself, because people start to change their behavior. And in March 2024, the Bank of Japan did something even more incendiary. They ended yield curve control. They lifted their rates out of negative territory. I know, God forbid, sacre bleu. They signaled normalization. Now, that's not inherently aggressive in itself, but it definitely was overdue. Because markets are addicted by this point, and addicts panic when their supply gets cut out, right? If everyone is relying on this funded mechanism and it disappears, they have to reposition, they have to reassess, they have to recalculate, they have to re-hedge. Their entire thesis has to change. And where did it lose it first? The bond market. The bond market is always, invariably, inevitably, always the same place where it ekes out the reality first. Look at Japanese government bonds, also known as the Widowmaker trade, for good reasons, JGBs. The 30-year JGB yields, they've surged nearly 40 basis points this week. Now, it doesn't sound like a lot, but that's not normal. That's not normal. That's a 15% jump in long-term borrowing rates in days. Not weeks, not months, not years, but weeks. So ask yourself this. When was the last time a developed sovereign bond market did that calmly and without repercussions? I can't think of one time without it ending up in an apocalyptic Armageddon or Armageddon-esque event thereafter. Bond markets are supposed to be boring. When they move like crypto, something is definitely wrong. They're no longer boring. Truly is the FX move that was never meant to happen. But then it happened. Friday happened. The yen rallied 1% in 2 minutes. FS desks around the planet froze. It's another repeat of the Volmageddon trade again, of that volatility rising in the yen, of the unwinding of the carry trade again. Because FX doesn't move like that unless the liquidity disappears, the floor beneath you completely collapses, margin calls trigger, or the authorities intervene. And right on cue, reports surfaced of what they call in the business the esoteric, the much feared, the much vaunted rate check. Yes, that means when Japanese officials, possibly with the New York Fed in cahoots, are calling dealers around the world for quotes. Now, that's not casual, that is actually a threat. Even though it sounds benign, it sounds innocuous, no, that is a signal that intervention is on the table. They're basically saying to traders all around the world and fund managers and hedge funds managers, hey guys, look, the yen has got too weak. We are out here looking for business. We're looking for the trade. We're looking to show you where we're going to be taking the Japanese yen FX rate going forward. So prepare yourself for the future. But this isn't just Japan anymore. It's not isolated just to them. The United States is involved in this coordinated action as well. And this is actually the key part that is overlooked. Here's the part that you're not going to hear discussed on the mainstream media sites. It's the United States role in it all. Because Japan is a huge creditor nation to America. They hold like 1 trillion or more in United States treasuries, one of the largest foreign holders on earth. So if the yen collapses, Japan faces a very brutal choice. You either sell dollars to defend your own currency, like defend your people's purchasing power. Don't worry about the states that are basically causing you to be a vassal of them. They sell treasuries, they spike US yields, or they let bonds sell off completely, they let the yields rise, and they let the currency signal the inevitability. Either path is going to hurt the United States unless they act in coordinated fashion. So ask yourself this, right now, in this current Trump regime, in this American regime, can the US afford actually higher yields right now? Can they ever afford higher yields? When, especially, the context of the backdrop is so dour, 34 trillion in debt and more, massive unfunded liabilities, 1 trillion a year in financing costs, interest servicing only, not paying back the principal, election year deficits, exploding federal deficits, pension liabilities, healthcare liabilities, military expenditures going up. No, they can't afford it, absolutely not. And the cheap funding currency in the Japanese yen, buying the treasuries, is a linchpin in the entire economic policy and the strategy de jure of America. Let's call a spade, let's call a yen, let's call a dollar. Let's be very clear. This wasn't Japan messing up. This is dollar stress. This is dollar liquidity tightening at a pace that is unsustainable. Because when the dollars get scarce, the funding trades have to unwind. The carry trades have to snap back. FX volatility must explode. It has to leave the valve somewhere to decrease the pressurization. Japan just happens to be that pressure valve. It happens where the valve has popped first. It happens where the bubble has formed first in the global volatility surface that was once calm and benign. This was a global margin call. It's not just a regional story. But what does this mean for US assets? What does it mean for British assets? What does it mean for European assets? What does it mean for Japanese assets? To determine and answer that question, you need to understand what happens if the yen carry trade keeps unwinding, if the intervention isn't successful. Equities are going to face forced selling. Ooh, credit spreads are going to widen even further. Volatility is going to rise to unpalatable levels. Liquidity is going to disappear exactly when you need it, like the unworthy, insalubrious friend that it always is. But here's the kicker, here's the punchline. Policymakers are not going to allow that disorder to happen. And they have the firepower to back themselves up. So what follows the stress? Dollar weakness, liquidity injections, QE, quiet coordination or loud coordination, vociferous coordination, just like 1985, just like 2007, just like 2008, just like 2020. Which leads to one final question, boys and girls. If the system survives only by debasing your currency, by eroding your purchasing power, by elongating your retirement schedule, what exactly are you saving in? You're not saving in a robust denomination. You're not saving in a propitious appreciating currency. You're saving in something that is being actively eroded, hypothecated, printed out of thin air to save the insalubrious actions of these banks all around the world. Let's bring it home because we need to. This isn't a yen story. This isn't just Japan. This is the global funding system flashing neon red, not just burgundy, not just a little rouge, neon red, fluorescent red. And when the funding breaks, everything priced off of it has to reset very quickly. The only question left is this: who notices early, who positions early, who profits from it early, and most importantly, who actually saves themselves from noticing it early, and who finds out through waking up one day and their portfolio being down 20% or being margin called? That's the real question. Tune in for more. Hopefully we've helped. I don't claim to know everything. I definitely don't know everything, but I hope I've been able to elucidate some of the shenanigans and machinations going on in this world surrounding the Japanese yen carry trade. My name is Justin Banton. Ciao for now.